The broadcast is now starting. All attendees are in listen only mode.
Hi, everyone, and a very good morning, afternoon to every one of our listeners. I'm Aman, the Senior Manager for Gas Shipping at Drewry Maritime Research, and today I'm joined by Pratiksha Negi, who's the Lead Analyst, and Nisha Manav, Research Analyst at Drewry Maritime Research. And together we are going to be presenting the Drewry LPG Shipping webinar that takes the findings from our latest LPG Forecaster Issue 4 2025. And this is going to cover about a recap of, let's say, 2025 and an outlook of 2026, where we see the impacts of the fleet expansion and the US China policy uncertainty. Now, this webinar is going to be for 30 minutes, where we are going to be taking you through our key findings for 20, 25 minutes, and then we are going to keep some time for your question and answers. So the question answer chat box will be open at this time. This webinar is also going to be recorded, and the recording will be available at a later time on our media channels. So without further ado, let us dive into the LPG shipping market and start the webinar with, uh, okay, I think, yeah, that is changing, right? Yeah, with a recap of 2025. Now, the year has been a roller coaster with multiple vessel repositioning, changing trade policies, pattern changes, and demand concerns. And this is what we are seeing in this chart right here. So what we have are the spot rates for VLGCs on the benchmark AG Japan and US Japan routes. And throughout the year, there have been multiple changes. In the first quarter, we started the year with rates deflated because of the low demand and a vessel surplus forming as vessels ballasted to the west. Now, this was exacerbated by the winter storm and the delayed loadings at the US terminals. Now, this continued over to the second quarter, but the cake was taken by the US China tariff war and the trade pattern changes that were resultant of the tariff policies. China shifted their imports to the Middle East instead of the US, while other Asian countries they upped their US imports to pacify the market. And even through all this, the vessel surplus conditions continued to reign. The cargo swaps and reselling opportunities arose, and many countries took part in that. That was the whole scenario. This continued into the third quarter. Of course, there were some pacifying efforts with two 90-day pauses that led to vessel repositioning between the east and the west of Suez, creating a lot of disturbances and volatility in the spot trades. The market also improved on Asian demand, pre-festive stockpiling, and improved petchem demand from China and other Asian economies that brought the market in the third quarter. And as we had projected, third quarter remained the highlight of the year. It also contained the Middle East tensions, which raised the spot rates with the threats on the Strait of Hormuz and its impact. For early fourth quarter of 2025, we saw that the petchem demand has begun to slip. China's petchem demand has been slipping from September. India's imports have also been declining post the Diwali festivals. Vessel repositioning continues to happen from Middle East to US Gulf, following the one-year truce between US and China on tariffs and the port fees. And we will continue to see and observe how the trend is being followed. So far, we are looking at a stable 4Q25, and we expect that this stability can continue in the first quarter itself. So moving to the time charter rate, the story is a bit different. While we saw a little bit of resilience in the spot rates with a lot of volatility in the picture, the time charter market showed a different downturn. And according to our projections, we projected 22% decline in VLGC rates at the start of 2024. And now we are seeing a 20% decline. And this is because of the oversupplying market outweighing the spot rate gains and the uncertainty that is prevailing in the market. For 2026, we expect the market to be much more stable as compared to 2025. So some of the key factors that you can observe in 2026 is a faster fleet expansion that will happen at a rate of 7%. The LPG trade is also projected to improve to 4% from 1% in 2025, but there are still concerns with the petchem sector, which is consolidating in Europe and in Asia. There are also concerns about the slow economic growth projections as well. In terms of supply, it is going to be ample. The LPG prices are going to be low because of that, and that is going to be good news for the price sensitive economies where the demand can grow. In terms of the fleet, we do believe that the fleet supply is going to grow rapidly from 2026, but we expect some support from the rise in dry docking activity. The subdued scrapping is going to affect the market, and the vessel surplus conditions are continue to reign in 2026. Over the forecast periods, we are still pessimistic that the rates are likely to stay weak. Fleet growth is going to outpace the demand. The scrapping activity remains low, and we do not expect it to improve to a very high degree in 2026. But as the earnings decline, we do expect that that acceleration is going to be possible from 2027, with the larger carriers also hitting these scrapyards. Geopolitical risks remain far and plenty, with sanctions, canal disruptions, tariffs, all keeping the market on edge. And the trickle down effect is going to be expected on all the TC rates of the smaller vessel segments. However, the MGCs and MRGCs are expected to have a relatively stable TC rates due to their ammonia trade exposure. Now, covering the recap and a brief outlook, now it's time to quickly walk through the trade developments which have showcased massive changes, and we will also cover the supply part. So today we have Nisha Manav with us, who's a research analyst for the gas shipping team, and she's going to walk us through the trade developments, and she can also cover the supply. So Nisha, over to you.
Uh, Global LPG trade growth was low at 1.2% in 2025. And this, as discussed by Aman, was one of the major factors which drove a 20% decline in VLGC TC rates. So, all top LPG importers drove this decline. Starting from South Korea, South Korea saw a 5% decline in LPG imports. This decline was due to petchem sector consolidation, suffering residential demand due to demographic winter. For 2026, we expect a recovery in South Korea's LPG imports, but this will be majorly because of base effect. Our outlook for South Korea's imports will remain dismal due to planned shutdowns of its petchem units. Moving on to India, India, after a robust 24% growth in 2024, saw almost 2% decline in 2025. This was majorly because of how high Saudi CP prices and subsidy cuts in first half of 2025. Although imports recovered in second half, however, overall import growth turned to negative territory in 2025. For 26, we expect India's import growth to improve to 8% thanks to low Saudi CP prices, which will boost residential as well as industrial demand. Continued subsidy support through 2026 will also provide additional boost. Moving on to China, US China tariff war was one of the major factors which impacted China's LPG import growth, reducing it to almost 1%, which is the lowest since 2019. Landed costs surged and negative petchem margins worsened the situation. For 2026, we expect a recovery of import growth to about 7% as new PDH capacity, which is deferred from 2025, comes online. US China war tariff truce is expected to reduce uncertainty and keep import costs low. Moving on to Indonesia, low domestic production and sustained consumption has powered Indonesia's LPG import growth since the last few years and will continue to do so in 2025 as well as 2026. For Japan, Japan witnessed a 5% growth rate in 2025 due to stock buildup and absorption of non-US cargoes with China. For 2026, petchem sector consolidation, weak residential demand will keep Japan's LPG imports low in 2026. Moving on to LPG exporters. Although global LPG trade was low at 1.2% in 2025, but major exporters including Middle East and US saw a rise. US exported 69.8 million tons of LPG in 2025, registering a robust 6% growth, thanks to the robust natural gas liquid production and increased US export terminal capacity. Middle East exported 52.3 million tons of LPG, seeing a robust 9% growth rate from almost negligible in 2024. A reversal of OPEC plus production cuts and fast ramp up of LPG supply supported this growth. However, other exporters, including Russia, Algeria, Australia, saw a decline, keeping overall LPG trade in 2025 low. Canada, on the other hand, saw some rise, but a greater rise will be expected over the coming years. So, over the forecast period, we expect continued LPG import trade growth, with US and Middle East being the largest suppliers. Both the regions will show robust growth. In US, increased terminal capacities and robust natural production will support exports, whereas in the Middle East, new gas field projects will provide the boost.
Thanks, Nisha. And it's interesting to see that the market is expected to see ample supply throughout the forecast period. Now, this is going to be, supporting the lower price outlook that we have for LPG and will improve the demand for prospects across the price-sensitive nations. Of course, there are going to be concerns as it is going to be competing with natural gas and LNG in its form in many of the countries, and LNG price is also going to be coming down. So that is going to be a good scenario to look at and see what the projections will be. So although the demand concerns persist and ample supply will be there, let's shed some more light on what events and markets are going to perform in 2026. So now let's have both Pratiksha and Nisha, who are going to be taking us through the key events or the on watch areas for 2026. Pratiksha, you can go first.
Thanks, Aman. So let's have a quick look at the geopolitical front, and starting with the much talked theme of this year, the US-China tariff war. Now we have seen series of events happening between the two since April this year, which has led to major changes in the trade patterns, as has been explained by Aman and Nisha both. Now, despite the 90 days truce, the trade between the US and China has failed to revive, which has resulted in an overall fall of 32% in 2025. Now, as China moved away from US LPG, the country increased its import from other countries, mainly from Middle East and Canada. The similar story was followed by the US, which increased its export to other Asian countries, including Japan, South Korea, Indonesia, and India. Now, with the tariff pause and the postponement of USTR and China's reciprocal port fee until next November, we are expecting that the trade between US and China is going to improve in 2026, but it would be rather gradually, as charters' confidence will take some time, especially with the sudden and sporadic policy changes from the US that we have seen in 2025, which have and will keep the charterers to opt for a more cautious approach. Similarly, another important commodity includes ethane trade between US and China. Now, ethane trade also saw some threats coming out from the US, with US aiming to impose licensing on ethane exports to China, but later it was rather discarded. Now, unlike LPG, the ethane trade between the two remained largely uninterrupted, despite the short-lived turbulence that we saw in June. Towards the more longer period and going forward, we keep a positive outlook for ethane trade between US and China, with the overall ethane trade or global ethane trade to be reaching 15.4 million tons by 2028 from 10 million tons in 2025. During the forecast period, we are expecting that US will dominate the global ethane export, with China being its key importer. Now, this trade will be supported by the large number of ethane crackers coming up during the forecast period, along with the growing prominence and economic feasibility of ethane as a feedstock. The growing ethane production and demand will be, well catered by the growing ethane fleet, with over 100 VLECs to be operation by 2030. Now, most of these order VLECs will be owned by Chinese operators and owners. The trade will flourish, but some risk, like policy changes and downstream demand concerns, will remain. Now, I would like Nisha to walk us through the other key events and commodities to watch out throughout the during our forecast period.
The next faster growing segment under MGL trade is ammonia. Global ammonia trade is expected to reach 32 million tons by 2030. However, this is very low as compared to the expectations of growth in clean ammonia that was made in 2024. Limited projects under clean ammonia, limited progress of clean ammonia projects will restrict the clean ammonia trade growth. VLACs which were ordered for trading in clean ammonia are likely to serve LPG market. However, we saw some developments under clean ammonia, including first ever ammonia bunkering, development of green ammonia FPSO, first transport of clean ammonia cargo, and the most important one being green ammonia price discovery. In auction, in India's first ever auction, green hydrogen delivery prices were set at $591 to $641 per ton for 10-year contracts. This was significantly lower than the price that was discovered in Europe. Moving on to next development, which was trade pattern changes, which explained the canal transits in 2025. The implementation of LOTSA system kept Panama Canal transits low in 2025 as compared to 2024. Meanwhile, VLGC transits from Cape of Good Hope rose, thanks to US-China tariff war, which led to increase in exports of US towards China, Indonesia, and other Asian buyers. This led to increase in laden VLGC transits via COGH. However, the implementation of LOTSA system kept ballast transits from COGH really high, as the vessel owners seek to avoid LOTSA fees.
Okay. Thanks, Nisha. And of course, a lot of the VLGCs they have been yo-yoing from Panama to the COGH with a new train that has been forming that they are using the Panama Canal for the laden voyages and the COGH for their ballast ones. And of course, there is going to be a lot more changes that are expected in 2026 as well. The recent resolutions with the tensions, those are going to be, very key. We do not expect a lot of improvement or a significant on the VLGC trade or the transits through the Suez Canal, but it is going to be much more crucial for the petchem trade between Asia and Europe. It is going to open certain markets where the arbitrage was eroded since the tensions had taken over and the vessels had to take the longer COGH routes. So on VLGCs, the resolution to the Red Sea tensions, where the market players are still very cautious about, it is not going to have a very significant impact on the VLGC movements, but with petchem trade and the smaller carriers, of course, that is going to open a lot more avenues. It is going to improve the arbitrage and create more trading opportunities. So we can expect more trade changes and transit changes to happen in 2026 as well. So let me finally take you through the fleet development. Now, the LPG shipping fleet is projected to expand at a CAGR of 8%. Now, the forecast was cut by 0.4% this time. This was because of the weakening sentiment from the tariff uncertainty and the various regulations like the USTR, China port fees that have been bogging down the ordering. Apart from that, there is also vessel surplus concerns in this market because of the high ordering that was done in 2023-24. That is going to result in a lot of vessel deliveries from 2026, 27, and 28 combined. 26 is also going to be the year where we are going to see the deliveries of VLACs. These are the specialized versions of very large gas carriers, specialized to carry ammonia. And the first vessel is going to be delivered in 2026, but a lot more of them are expected to be delivered over 2027 and 28. Overall, right now we are seeing between 60 to 65 VLACs on the order book that are due to be delivered between these years. However, because of the limited clean ammonia quantities that are going to be available, we expect that these vessels are not going to be plying on ammonia trade, but are going to be confined to the LPG trade, at least till 2030 or let's say 2032. Now, this altogether with the newer VLGCs and the NGCs that are going to be delivered in our forecast period is going to create a vessel surplus, and the fleet growth is going to be outpacing demand throughout the period. In terms of the demolitions, it has been slow in 2025 as well. There has been no larger or major vessel that has went to the scrapyards, and this is because of the still high earnings that the sector is still providing for the owners, and also the uncertainty that has been created because of the geopolitical risk and the tensions between the policy changes that are happening. So owners continue to retain their older tonnage with hopes of utilizing them in particular areas where there can be some demand. However, as the earnings weaken in the forecast period and the regulations compliance become more stringent, we are hopeful that the scrapping activity in the larger segments is going to accelerate. Maybe in 2026, there is going to be some toe dipping from the owners who are looking to scrap their older vessels and replace them with the more modern ones. But from 2027, we see that we expect that a much more pronounced effect is going to be seen with more of the larger vessels, the VLGCs and FGCs, going to the scrapyards. In terms of orderings, the new orders have been subdued in 2025. Only around 50 orders have been placed in 2025 so far, as compared to the 155 that were done in 2024 in the same period. Now, the subdued orders are because of the trade uncertainty, the change in policies, the USTR and the China port fees, and also the vessel surplus concerns for the forecast period that we are seeing. So in 2025, we didn't see a lot of the orders in the larger segments, but it was replaced by replacement orders happening in the smaller large coaster and small coaster segments, where PR orders dominated the new ordering trend, while the total ordering scenario was down 60% year on year. Now, with the USDR impact, the share of orders at Chinese yards continued to decline, and overall, China now has a share of 41% in the overall LPG shipping order book, which has declined from 45% earlier. South Korean yards, they continue to hold a steady 38% and are also getting new orders for the smaller vessels. But the shakeup because of the USTR regulations have allowed new competitors to join the fray. And a lot of the Japanese yards have come into the picture, and they have focused on the large coaster MRGCs and the VLGCs, and gained a lot of orders. Now, for the VLGCs, most of the orders are from Japanese companies, but for the small coasters and MRGCs, they are starting to gain orders from international customers as well. So even with the 1 year truce, there is still a lot of concern of what is going to happen after 2026. So that is keeping the owners on the back foot. And we expect that the ordering trend is going to continue to be the same in 2026 until some genuine, concrete evidence or sentiment is created. So for 2026, we expect the ordering is going to remain low, but we do expect some replacement orders to emerge, with the owners wanting to renew their fleet and pass on their older carriers in terms of second-hand activity. So this was from our webinar. Let me quickly take you to the key takeaways. So the VLGC rates are declining by 20% in 2025, and for 26 we are projecting a 4% decline. So a more stable market expected in 2026. Fleet expansion was slower at 4% in 2025. That supported the market, but it is going to accelerate to 7% in 2026 and will continue to grow in 2027 as well. New ordering was low in 2025 because of the vessel surplus concerns, and this trend is likely to persist through the next year. Of course, there are going to be some replacement orders that will continue to happen. On the trade front, the growth is going to recover in 2026, but we have concerns about the petchem sectors that continue to weigh on long-term growth prospects. The shining armor will be the ammonia and ethane trade, which are projected to continue to grow rapidly in 2026 and in the forecast period as well. In terms of supply, we expect the exports to rise from the US on the basis of higher production and increasing terminal capacities, and from the Middle East with the new gas field projects under development and favoring OPEC plus production cut reversals. Now, these increase in exports are going to keep the LPG prices subdued, and it will add growth from the residential and price sensitive markets like India and Indonesia. As I said earlier, LPG can become a very good competitor to natural gas in particular sectors and countries where the demand can grow for this particular commodity. Of course, there are some on-watch factors for 2026 and uh, further on as well. Namely, we have got the Middle East tensions, the US-China trade policy, China's demand concerns, US export capacity growth, and the Panama Canal congestion. So all these together will be the factors that can have an impact on our forecast and the British shipping market in 2026. Okay. So that was all from us. And now we can take some questions. Let me take it. Okay. So the first one, I think, Nisha, this will be for you. So what is your outlook for LPG prices in our forecast period? We see frequent arbitrage changes due to LPG prices decline and volatility. How will it impact the LPG trading patterns?
Thank you, Aman. Saudi CP has reduced its prices over the last 3 years. Now it has been down to $475 per ton for propane. And we expect a continued decline in not only in Saudi CP prices but also in Mount Bellevude prices, as to maintain competitiveness, US will be forced to reduce its prices as well. This has narrowed down the arbitrage so far in the last 3 months as well, and we do expect a swinging arbitrage for the coming months as as LPG prices will remain low and the influence of other factors, including spot rates, will become more dominant. This will lead to frequent shifts in the trade pattern, as was seen in November as well. We saw a rise in Middle Eastern exports because arbitrage was favoring Middle Eastern exports. And if US is successful in increasing its export capacity and in reducing its Mount Bellevude benchmarks in line with the Saudi CP prices, the arbitrage can tilt in its favor.
Thanks, Nisha. Okay. Uh, so the other question is, what is your outlook for small LPG handy-size vessels? Any takers for this one? Nisha, Pratiksha? Okay. So I can take that one. Of course, the coastal market that is under a little bit of a strain. It is a mixed outlook that we are projecting. Of course, the fleet itself, it is a big fleet which has around 600 plus vessels, but it has a very high age profile as well. So it has a lot many aged vessels. And with the changing trade patterns, we are seeing that it is going to witness a lot more competition from the larger uh, vessel sizes. We are already seeing an upsizing trend in the orders that are happening in 2025, where the scrapping has been done for the small coasters, but the orders that have been placed are for the larger ones and for MRGCs as well. So we do see that there is a rebalancing happening in the coastal market, but it will continue to remain essential in some places where, let's say, for instance, for island countries like Indonesia and the Philippines, the coastal market is going to be, the most crucial, and it is going to continue to work that way. Most of the vessels are also used as captive for particular plants and ports which do not have the capability of providing support or docking for the larger VLGC or MGC carriers. So the market needs some balancing, but what will come out is going to be we are projecting higher rates down the line, but that will be after 27, 28 when the fleet has shrunk. There are going to be modern carriers for it. And Regionally, the outlook is going to be much different, for which I would like to propose that you get our forecaster and subscribe to it and read about it there. Okay, so we are just about there. So let me just take one more question. So how many vessels do you estimate are there in dark trade? And what will happen to these vessels if the sanction scrutiny increases? Okay, so I can take this one. Um, so to have the exact number is going to be very difficult. But in terms of VLGCs, we have seen that around 50 to 60 vessels are already plying on the dark trade. And now tracking them is going to be very difficult because sometimes we have our own Drewry AI system. They can pop up on one end of Middle East at one point, uh, then they can come up near UAE or Oman, and then suddenly you will find them near China. So those kind of things will continue to happen. In terms of the sanction scrutiny, if it starts to increase, uh, we don't expect that these vessels will have it in them to come back to regular trading. But for scrapping activity, we are also very unsure whether these vessels will be scrapped as well. So our outlook is that the owners will likely just sustain onto them. Some of these vessels might be abandoned if the sanctions scrutiny increases, while some vessels might be used as floating storages as well. So in terms of scrapping, they are going to come into the picture, but that is also going to be at the far end of our forecast period. So that was all the time that we had for the questions. Unfortunately, we ran a little bit too long, but we have also or we have got all the questions logged in, and we are going to be replying to each and every question through emails that you can receive shortly afterwards. And of course, if you have any more queries, our email IDs are on the screen. So please provide your feedback or your queries to us directly, and we will be very happy to receive them and to reply to you. So on behalf of Pratiksha and Nisha, this is Aman signing off. Take care, and we will see you in 2026, as this was the last LPG webinar of 2025. So we hope that you have a happy new year and see you on the other side. Thank you. Take care.